Well, g'day the traders and market enthusiasts right around the world. You are here with James on behalf of Pivot Point Trading as I sit down and bring you this Wednesday afternoon market recap. The reason for this video is because it looks as though the market itself has had a blow-off bottom. Today we saw the Dow Jones Industrial Average down quite significantly during the intraday trading session. However, towards the end or about mid-morning onwards, buyers started to show up right around this very important level here, which has already been on my screen for quite some time, around 15,638. You can see this very long lower wick here on this particular candlestick. It is not that of a hammer or a hangman type of candle. It's sort of a hybrid. It is at support, and it's very important at least that you understand just what to expect given the type of daily candle which we've been waiting for really this week to set up. It is Wednesday afternoon as I sit down and record this. Monday obviously was the public holiday. The US markets were closed. Tuesday we saw that doji candlestick where it was looking as though once again potentially it may be the bottom, but given today's trading session, the way in which this candle has formed, it looks as though the market is starting to have again a blow-off bottom. We've been fantastically profitable during this entire sell-off. We've caught the move from 17,126 first of all to our first target down here at 16,550, and then just at the close of today's trading session, target number 2, 15,638. In my personal opinion, as I sit down and analyze the financial markets through technical analysis, it makes a lot of sense to me given the volume and of course the intraday candlestick movement that we are basing right around these August 2015 lows. I put out a video maybe a week ago explaining that, hey, there's the potential that this market may turn on a dime, so to speak, right from, I guess, the mid-January type of digestion. However, again, the markets did break down. Instead, we did break below that late September and early October low. However, we have not broken below that August 2015 low. Now, the reason why I'm speaking about this is because given where we are currently trading on the markets or at the location on the Dow Jones Industrial Average, a lot of people are going to be once again calling that this is once again a higher low, and that is very, very risky to buy into that narrative. It is not a higher low. The bullish trend, or at least the primary trend, is breaking down before our eyes. And often what will happen is we'll come back down, maybe even establish a higher low relative to the low in September and October, and we'll see the bullish movement back up into the back test of this neckline. This is what I've been calling for a number of weeks right now. And again, as at this Wednesday, I need to sit down and explain this to you because it's very important that you understand what I have to say. The primary trend is what is most important at this particular juncture. If I zoom out and show you this on the Dow Jones Industrial Average, we've had this congestion throughout the year of 2015. We saw the big breakdown in August. We've come back up. We've really just come back and retested what we were once describing, or at least possibly thinking that it could be the possible bearish primary trend. This did hold, and we saw the market once again capitulate back down to these relative lows which we've been establishing really since the beginning of 2014. Again, we came back down very briefly towards the end of 2014, and again we've made this head and shoulders chart topping pattern. Once again, a lot of people are probably going to get whipsawed into a lot of bearish trades. This is not the position where you're wanting to look to go short, all right? Because the reason why is because we are going to see, or there's a very high chance, it doesn't mean that it has to happen, that we are going to see a bounce. We can see the Dow Jones Industrial Average very easily rally all the way back up to 17,000 and still hold the primary bearish trend. In fact, it wouldn't surprise me whatsoever to see the market, or at least the Dow Jones, coming up even a little bit higher, maybe even as high as 17,250. What you want to be paying attention to is where is the 50 exponential moving average, and as you can see, it's coming in on my screen about 17,067. And also, if I just start combining, of course, the simple moving averages, you can see the 100 and the 200, which is going to act as very nice resistance when the market comes back up and makes that retest. That is what I'm expecting to happen. It's probably going to flow back into, or at least flow into, February 2016. You may be asking yourself the question, well, if we're looking for a bounce at this macro support level, do I want to go long? And that is a question, or at least an answer, which you will have to come to, some form of a personal conclusion on. Personally, as I sit down and evaluate these markets, look at this through technical analysis, these types of trades, these counter trend trades, and I say counter trend because the primary trend has established itself, and we are making consecutive lower highs, which again is the definition of a bearish trend, and of course lower lows as well. These counter trend moves back into the declining exponential moving averages and also into the 100 and the 200 simple moving averages are where resistance is going to show up. You couple that with support and resistance, of course, support which is now turned resistance into the future, and you get these areas, these very logical areas on the chart where you expect price to come back up into and roll over. The first or the most important, poignant, really piece of analysis which I can give you in this Wednesday afternoon market recap is the trade in the direction of the trend. And you have to ask yourself the question, which direction is the trend moving? Which direction is the primary trend set up, and where is the market? Where do we at least expect it to move into? Maybe for the next 3 to 6 months. And the answer to that question, given the type of analysis which we're seeing in the broad type of breakdowns in the Russell 2000 and also the Dow Jones Transportational Average, is that this market unfortunately has got lower lows to put in. However, before we get there, we are, in my opinion, going to go through this bounce. I'm not trading the bounce. I can see it happening. Instead, I'd rather re-add to my long-term hedges and then position myself into a lot of individual trades when the market is telling me that the primary trend is about to continue. Again, this is going to be an intermediate counter trend move back into the primary trend line, or at least into resistance, and you have to be very, very careful. You may be scratching your head right now as to why I'm so, or relatively bullish in the face of such a bearish sort of waterfall sell-off, and the reason why is because we're just so extremely oversold. If you have a look at the stochastics, if you pay attention to the RSI, these are areas at least where we haven't revisited in quite some time. The RSI hasn't been this oversold since August 2015 when we saw the market itself break down. On top of that, if you pay attention to the ADX, I spoke about this over the weekend in Pro, we are at extremes. We've hit that 58 level, and when we get to this extreme reading, first of all, very rarely do we get there, but when we do, the market itself plateaus. It either stops, it moves sideways, or it reverses the current trend, and that trend itself has been down. We're looking for the market to at least slow down, to stabilize, to move sideways, to hold support, build structure, and then once the structure is built, potentially we can set up some bracket trades. There's some contingent orders below 15,323 if the market does want to break down. But if we get really nice structure, then we can start, positioning ourselves for, hey, if I want to take on a little bullish trade back up into this resistance area, then it'll be the right opportunity to do it. At the moment, however, the market itself is just extremely oversold, and we're starting to see this flow into, of course, Wednesday's trading activity. It looked for a moment there that the market was going to blow through support. It looked as though more or less we were on the precipice of a crash. However, as I expected, and I say that very humbly, support has held, taken motion out of the trade and just analyze the market, the ebbs and flows of the market, get the primary, the intermediate, and of course the minor movements, which we trade as technical swing traders. And of course, you do very well trading this market. Two stocks which I want to speak about very quickly. CVX, I'm not sure if people took the trade. This is a trade or a potential trade once we had structure. I went through this in great detail. I spoke about these 7 candlesticks right here and how we had these really nice lows forming on this particular trade. And I said, look, if it breaks 79.17, our next target is 75.98. Now, if you're in this trade, you should more or less be out of it in a day. It happened very, very quickly. We moved from $82 all the way down to $75, which was a major sell-off. However, we have that long lower wick as well, so you should have exited this trade at your target. If you're still in the trade, place a stop on it, and if we get another pushback down in CVX, I'd look to exit out of that trade immediately. Google today, push below 688. This is the gap fill of Google, which I've been speaking about again for a little bit of time. 688 was my target. You can see up here, this is the low of the daily candle. It came in at about 687. Let me have a look here, 687.78. So we've hit our target on Google. Personally, I was stopped out at 751.50. I'm not going to shy away from that. So I missed out the actual target on this trade. It was a lovely trade setup, open window which filled. And, if you held on to this trade, you've done exceptionally well. You should have banked a lot of profit on that individual trade. A lot of these individual stocks, nonetheless, are also putting in some types of reversal candlesticks. IBM had a really bad earnings report. I think it was the 13th consecutive month of declining revenues. And again, we saw that gap down to 118. We are at a support level, so I'm not trying to play IBM, a continuational trade. And the other trade outside of that is Netflix. Netflix came down to 97.48 today. It was an ultimate target, but we were well and truly out of this trade. Personally, I didn't even take it, and I explained to you as to why that was, because of this volatility, which I was expecting in Netflix to show up. But nonetheless, earnings was released 2 days, or yesterday actually. It gapped up 10%, down 6% during the day, and we closed more or less right where we opened. on the Wednesday, or at least on the daily candlestick for Netflix. So, I mean, there's a lot of volatility in these individual stocks. A lot of these stocks, if I go through them, Apple is looking to reverse. I mean, it's trying to put in a little bottom here. Amazon's been fantastic. We're trying to look at this bullishly, but still, we need to really patter out, I should say, a structural support here around 569. It's still not there. The structure still isn't there. Boeing Airlines broke down below 126.01. It's looking really nice. If you're in this trade, you need to get out of it. Earnings is just around the corner, and of course, it is another very profitable trade, up about $4, but please close out a lot of these trades. Baidu was one of the stocks which I spoke about over the weekend as to where or how individual stocks are positioned given or relative to where the actual Dow Jones, the S&P, and the NASDAQ are. So we're sort of saying to ourselves, well, look, we're expecting a base on the market, and there's only a select few stocks when you get good with analysis, when you feel comfortable with your analysis, where you say, look, I'm willing to trade these short, even though I know the market is still oversold and I'm expecting a bounce. And Baidu wasn't one of those stocks. If you're in it, you've got an opportunity to get out of it more or less at break even, especially during the day. It may have even been somewhat of a profitable trade. But again, now's not the time to be looking at short trades. It's to be thinking about a bounce in the market. I think we have that as at the close on Wednesday, and it's going to flow through to a lot of these individual stocks. Caterpillar is another stock which has been fantastic for us. And over the weekend, this is how I'm going to end this Wednesday afternoon market recap. I spoke about filling gaps, and that was really, a big theme of the week's discussion. Google's was one of those stocks which filled the gap. And I went back and I explained this to a lot of people as well. Goldman Sachs, it wasn't Goldman Sachs. Let me just think through this, which potential or which particular stock it was. There we go. Amazon. Amazon was the other one which has just filled the gap. And I spoke in detail about how markets like to close open gaps. Well, let's just point, or at least compare this into, or at least use that analysis in terms of the NASDAQ. The NASDAQ has been, selling off quite significantly. We're at multiple areas of support, not only horizontal support, but also long-term trendline support. If I zoom out on the weekly chart and extend some of these fan lines, you can see that this is the primary trend of the existing bull market in the NASDAQ. I'm expecting it, that's my battery, I need to plug in my laptop to break down. But I'm not thinking, or it doesn't look as though it's going to break down below this level. Now, going back to the level of gaps, or at least the discussion on gaps, we've got open windows up here. We also have a couple of windows here and also here. So not only on the Dow Jones Industrial Average, it's not best represented on the Dow, especially on the NASDAQ. It wouldn't surprise me to see the NASDAQ even come back up to around that 5,000 psychological round number. So if you put that into a point term, that's about 530 points that the NASDAQ can potentially run to, until it makes a lot of sense that, hey, we're at this gap and this is where we're going to turn, reverse, and slow down. And of course, the S&P 500, it makes sense to see this come back up to around that 2,000 area. We'll just pay attention to it. Of course, this is a little bit premature because we haven't seen any follow through into the equity markets. It may take a number of days, if not a week or so, to actually base here before we have, of course, the friction in the market itself for really buy the dippers to come back in and to try and drive this market higher. Unfortunately, the end game of all of this, panic buying and people probably trying to jump in at a discount is that ultimately all of the people, just like the people who bought in November and December and also leading into these 2 months, were probably the ones adding to the sell-off because their positions became underwater, or at least they turned negative, and they wanted to sort of just move out of them very, very quickly. The same is going to happen for people buying down here. So if you're looking at short-term trades, keep them short-term. I don't expect this market to break above 17.7, and if it does, it's probably just going to set up another fantastic shorting opportunity. But since the entirety of November and December, we've been talking about hedges. Those hedges are working out absolutely brilliantly. I cannot talk about, in percentage terms, just how well people have. But these are long-term trades where it doesn't really matter what the individual daily fluctuations of price are doing. You just simply hold on to them and know that ultimately this market is most likely heading lower, and those positions are going to take care of themselves. So it's a very powerful way to position yourself in the market. It's fantastic trading the intraday movements on individual trades when they set up, but you need to keep that big large-term perspective on what the market is doing and where it is going further into 2016. If you'd like to learn more, traders and friends around the world, have a look at Pivot Point Pro, sign up and get into those educational resources, which I provide people with each and every weekend. It is a Saturday. I sit down and go through about 90 minutes of analysis on the 3 US markets, the Dow Jones, the S&P, and the NASDAQ. We also look at the Russell 2000, or most recently anyway, we've been looking at the Russell 2000 and the transports in conjunction with also the price of gold, silver, and the US dollar, because of course there's this big wave of deflation spreading around the globe, which is of course affecting commodity prices, and the US dollar continues to appreciate in value. And people are still scratching their head as to why gold and silver are down and the US dollar continues to appreciate. You can't fight it. it is what it is. You just need to recognize it and trade on the right side of the trend, as I've been trying to explain to you in this very quick market update as at the close on Wednesday. So everyone right around the world, on behalf of myself, it's fantastic providing you with these market updates. And there goes my reserve battery power, so I must plug this in right now before I lose the recording. Everybody have a fantastic evening. I'll see you all in the weekend in that pro analysis class. If in fact the market breaks down below this macro support level, which is not what I'm expecting, I'll bring you another market update and just explain what is going on. But the fantastic thing about it, once again, is that we've positioned ourselves in hedges all the way up at about 17,500. In fact, I started taking these on and talking to people about the hedges at 17,633. Ask yourself the question, what could you do? Or what would you do if you could go back and start positioning some of these hedges, which I've been speaking about for a number of months? We may have one more opportunity, and I'll go into that in great detail over the weekend. I'd encourage you to have a look at that, because it's really going to be a game changer if in fact this big unraveling is what we're sort of moving into to begin 2016. And there are a lot of macroeconomic signs which are saying, hey, be very careful, be very cautious about what is happening in the world. And also when we work with the technical picture, it definitely backs up everything which, some of these rogue economists are stating, some of these factual evidence of the underlying economy. It's really showing up in the technical picture as well. So it's something to consider, something to think about, and I encourage you to have a look at that educational facility, that educational resource which I provide people with each and every weekend. Outside of that, friends and traders, I'm signing off. I'm going to plug in this battery, upload this video, and have a nice day the rest of my day nonetheless. Okay, everybody, have a fantastic evening. I'll see you all in the weekend. Goodbye.